Okay, now we're going to talk about purchase transactions. We're going to talk about merchandising transactions overall, but the first one we're going to talk about is purchase transactions. So I want to be real clear about something here. In every transaction, in a merchandising transaction, you will be either the buyer or the seller. There's a lot of confusion because the terminology is used the same as far as buying and selling goes, but you need to figure out which one you are. And so for the first part of this chapter, we're talking about purchasing. So we are the buyer. After that, and I'll separate the videos out, don't worry, but after that we'll be the seller, okay? But you're gonna have the terms be real similar. You're gonna have credit terms, you're gonna have inventory, just a matter of whether you're the one actually buying the inventory or whether you're selling the inventory itself. So make sure and keep that straight. It's probably the area that confuses students more than anything else in this chapter, so I want to kind of give you a heads up on that. Okay, so I'll let you read through the part of the chapter that talks about the subsidiary ledgers. Those are just ledgers that we keep that are special journals that kind of are checks and balances to make sure that our overall general journal is correct. So we'll start talking about purchasing. So if I buy inventory, and if I buy inventory, the entry is relatively simple. If I buy it just for cash, then I would just debit inventory, my debit, my credit, debit inventory for whatever the cost was, and I would credit cash for whatever the cost was. So let's say I bought $10,000 worth of inventory. I would increase inventory by $10,000. That's that new asset account we have for this chapter. And I would credit cash for $10,000 because I spent money. If I buy that inventory on account, I would have the same thing. $10,000, except for I wouldn't have cash. On account means that no cash changed hands and I owe it instead, so I need to book a liability. In this case, it's generally called accounts payable. Okay, so that would be just a normal transaction without any discount, trade discount, or anything. This is buying inventory for cash, and this would be what it would look like if I buy inventory on account. Okay, so using a liability account for that instead. But something that's really common in buying and selling of merchandise is to offer discounts, where if you, and we're talking about purchase discounts here, where if you pay early, and this is to motivate people to pay their bills early, that they can offer you a discount for that early payment. So there's kind of a wording that they use that's odd that you probably haven't seen unless you've worked in inventory before. But here's how it works. We'll delete this over here and I'll show you. So the invoice will say, it'll say a number, and let's say it's 2, and it'll say, and it'll be a slash and then another number and then comma, then usually an in, and then another slash and then another number. So here's what these numbers mean. First number is the percentage discount offered. So in this case, the first number is 2, so I'm offering a 2% discount. The second number after the slash, second number, is the number of days that it needs to be paid in order to get the discount. So in this case, you get a 2% discount if you pay within 10 days. N generally means net, which means the whole thing. Okay, you got to pay the whole thing. So N is just the net or the whole amount. And then the last number, is when the total amount is due. So in this case, if we buy this and we pay for it within 10 days, we get a 2% discount. If we don't, we have 30 days to pay the full balance. So the first number is the percentage discount offered. The second number is the number of days that you have to pay within to get the discount. N generally just means the net or the whole amount. The last number is the total amount due. So in this example here, the one I just did, no, I just got rid of it, but if there was a 2% discount offered, by the way, discounts can only be offered if I don't buy it in cash. Can't offer, well, there can be cash discounts, but those are recorded differently. So if I am doing this for the entry I just had a second ago for $10,000, if they offered this 2% discount, I would take that out up front, assuming that I'm actually going to take that discount. So I would have the value of 10,000, and if I take that number times 2%, 0.02, I get 200. So in that case, I'm only going to pay $9,800 for this inventory, not $10,000. So I book it as such because inventory is always held on my books at cost. And this inventory, if I take the discount, did not cost me $10,000. It cost me $9,800. So $9,800. When I actually pay the accounts payable, similarly, I would pay off all $9,800, debiting the liability, reducing the liability, and I would credit cash, credit the asset to reduce the cash since I'm paying that money out. That would be an example of taking the discount and recording it as such. Now, this number can change. This could be 1%, and it could be 15 days, and net 45. It doesn't matter what these numbers are. The nomenclature, the way that it works is always the same. The first number is a discount, so now it's 1% discount. Second number is the number of days paid, so now it's 15 days. If they need to pay within 15 days to get a 1% discount. If they don't, they owe the whole amount, the net amount, in 45 days. So that's how that journal entry would work. So now what happens if I receive all this inventory, but some of it I don't want? Either that or it's not up to my standards. What happens if I return it? Well, if I return it, then I would simply take it out of inventory and give it back. So I would show that I no longer owe the liability, and I also no longer own that inventory. So I need to reduce inventory, so I need to credit that asset. I need to reduce the liability, so I need to debit accounts payable. The issue here, though, is I already booked it like it had a discount on it. So I would need to make sure and recalculate that. So let's say that I return $2,000 worth of inventory, and when they give you that number in the book, they're talking about $2,000 from the initial price. This is a 10,000 was the initial invoice price. This is the return amount from that initial price. So since I didn't book all 10,000, I took the discount out. I need to figure out the discount on this. And I know I went and changed it, but it was 2%. It was the discount that we had on this before. So 2,000 times 0.02. All right. 37 times 0.02, which gives me $40. So I need to take that out of the 2,000. So 2,000 minus 40 is 1960. So I would reduce my accounts payable, this would be for the return, by 1960. And I would decrease my inventory because I no longer have that inventory by 1960. So this would be the initial purchase with a discount of two. Let's change it back to what it was so you can see it. 210 and 45 really doesn't matter in this case. So 2% discount. If I return some, I need to make sure and take the discount out because it's in my inventory with the discount in it. And then once I pay it, this would change too because I no longer owe $9,800. I owe $9,800 minus what I returned. So I only owe $7,840. So I would debit accounts payable for $7,840 and credit cash for $7,840. That would be the actual amount of cash payment that I did. So this is the initial purchase, and this is a purchase transaction where the buyer, not the seller. This is the return of inventory, $2,000 as far as the invoice price goes, but I have to take the discount out. And this is the payment of that invoice when it is due. In this case, it's 45 days. So actually, no, 10 days because I took the discount. So this would be paid within 10 days. I'm going to stop this video here. The next video, because I think this is complicated, I'm going to do an example exercise. You can see it down here. So I'm going to work through that to show you how to journalize another transaction really similar to what we just did in this video.